In the world of high finance, there is one law of physics that cannot be broken. Risk equals reward. If you want a 10% return, you have to accept a 10% risk of volatility. It is the fundamental law of the market. But for 20 years, one man appeared to have broken that law. His name was Bernie Madoff. While the world economy was a roller coaster of the 1987 crash, the dot-com bubble, and the post-9/11 recession, Madoff's investment fund didn't just grow, it grew at a perfectly steady, unwavering 45-degree angle. It didn't look like a market chart. It looked like the heartbeat of a dead man. It was a $65 billion miracle that promised the safety of a bank account, with the returns of a tech unicorn. But as thousands of retirees, charities, and Hollywood icons were about to find out, Madoff hadn't found a secret way to beat the market. He had simply engineered the most successful lie in human history. This is the anatomy of the largest Ponzi scheme ever recorded. To understand why this worked, you have to understand who Bernie Madoff was. He wasn't a shadowy figure in a basement. He was the bedrock of Wall Street. Madoff pioneered the very electronic trading systems that evolved into the NASDAQ. In fact, he served as the chairman of the NASDAQ in 1990. He was the man who regulators called when they wanted to understand how the market worked. He served on the board of the NASD and the Securities Industry and Financial Markets Association. This was the ultimate social engineering hack. Because Madoff was the regulator, nobody believed he needed to be regulated. His legitimate brokerage firm was wildly successful, processing up to 15% of all trading orders for the New York Stock Exchange. He was a philanthropist, a donor to the Democratic Party, and a pillar of the community. He didn't just operate within the system. He was the system's primary architect. The brilliance of the Madoff fraud was its segmentation. On the 18th and 19th floors of the Lipstick Building in Manhattan, Madoff ran a cutting-edge, legitimate brokerage business. But the 17th floor was different. The 17th floor was a time capsule. It was restricted, separated by keycard access, and filled with old IBM computers and manual paper trails. This was the Wealth Management Division, the epicenter of the Ponzi. While the upper floors used high-speed algorithms, the 17th floor was a factory for manufacturing fake reality. Every night, a hand-picked staff of loyalists, some who had been with him since the 70s, generated thousands of pages of fake trade confirmations. They used historical data to backdate trades. If a stock hit a low at 10 a.m., the 17th floor would print a confirmation showing they bought it at 10:01 a.m. On paper, Madoff was a god-tier trader who never missed. In reality, he was just a printer with a Chase Manhattan bank account. Madoff's secret sauce was a technical-sounding strategy called split-strike conversion. He told investors he would buy a basket of S&P 100 stocks and then hedge his position by buying put options and selling call options. It sounded sophisticated, mechanical, and low risk, but the math never added up. As early as 1992, external analysts began flagging the SEC. They pointed out that for Madoff to be executing the volume of trades he claimed, he would have to be buying more options than actually existed on the entire market. The SEC investigated Madoff multiple times over 20 years. They looked at his books, interviewed his staff, and even took his testimony. But they were looking for a technical error in his math. They never realized that the money wasn't being traded at all. It was simply sitting in a bank account, being used to pay returns to old investors with the cash from new ones. It was a classic Ponzi scheme scaled to an industrial global level. Every Ponzi scheme eventually reaches terminal velocity, the point where the withdrawals exceed the new deposits. For Madoff, that moment was the 2008 financial crisis. As the global economy melted down, Madoff's investors panicked. They needed cash to cover their own losses. In a single week, they requested $7 billion in withdrawals. But the bank account at Chase was dry. Madoff, who had been hemorrhaging cash to keep the mirage alive for decades, only had a few $100 million left. On December 10, 2008, Madoff confessed to his sons that his multi-billion-dollar business was one big lie. The next day, FBI agents entered the Lipstick Building. The miracle was over. The fallout was catastrophic. $65 billion in paper wealth vanished. Charities went bankrupt, retirees lost their homes, and Madoff's own family was torn apart by suicides and prison sentences. Bernie Madoff was sentenced to 150 years in prison, a sentence meant to match the scale of the lives he destroyed. He was ordered to pay $170 billion in restitution, a symbolic gesture for a man who died in prison with nothing. Madoff's legacy isn't just the money that vanished. It is the permanent scar on the concept of trust in the financial system. He proved that even with the most reputable resume and the most sophisticated technology, A-player institutions are only as strong as the people willing to question them. Because in the world of finance, if a return looks too good to be true, it's not an investment, it's a countdown. Thank you for watching.